Could the future of global stock markets be on shaky ground? Picture this. J.P. Morgan, one of the world's largest and most respected financial institutions, forecasts a significant decline in global stock markets. They predict a drop of 20 to 30% from a peak expected this very year, 2024. This isn't just a blip on the radar. The implications are significant and they're worth understanding, so fasten your seatbelts because the ride could get bumpy. First, consider the limited upside potential for equities. The market giveth and the market taketh away. But what if the giving part is over? J.P. Morgan warns that the potential for further gains is dwindling. The proverbial well isn't dry yet, but it's certainly not overflowing. Next, let's delve into the murky waters of market discrepancies. The inverted yield curve, a phenomenon where long-term debt instruments have lower yields than short-term debt instruments, is a classic signal of potential economic downturn. This inversion has been a reliable precursor of several past recessions, and it's back on the horizon. Adding to the storm, there's a noticeable lack of a risk premium in U.S. equities. In simpler terms, investors aren't being adequately rewarded for the risks they're taking on. This imbalance could lead to a flight of capital from equities and into safer assets. But the plot thickens. Historically, low-yield spreads have often been a harbinger of economic trouble. When the difference between short-term and long-term interest rates narrows, it can signal that the market is expecting lower interest rates in the future, often due to slower economic growth. Finally, consider the impact of aggressive central bank interest rate hikes. As central banks raise interest rates to keep inflation in check, borrowing becomes more expensive. This can slow economic growth and in turn drag down stock markets. So, what does all this mean? In a nutshell, we might be standing at the precipice of a significant market downturn. The signs are there: limited upside potential for equities, market discrepancies like the inverted yield curve, a lack of risk premium in U.S. equities, low yield spreads and aggressive central bank interest rate hikes. Remember, knowledge is power. Understanding these factors can equip you to navigate the choppy waters of the global stock markets. Stay informed, stay vigilant, and most importantly, stay prepared. The future may be uncertain, but with the right information, you won't have to face it unprepared.